So we're at 12:05. So thank you for everyone coming on today and listening. To what I see is I've been doing this now for since 2008, coming on 16 years. So one of the best opportunities that I've seen in the Toronto market ever. And we're going to get into the math and trends behind that. Let me just Okay, so first off, for those that don't know me and Niesh, my business partner, my name's Alex Wilson. I'm owner and broker record of Remax Wealth Builders Real Estate. Been selling real estate for over 15 years. In 2022, I was recognized as the #1 Remax agent in Canada for individual transactions. I've achieved Remax Hall of Fame status, received their Lifetime Achievement Award at 35, and I've received the Remax Circle of Legends Award at 40. I am currently 42, going on 43. But more importantly, and why this all matters to you, is that I'm also a big real estate investor as well. And I started investing in 2012 with a $39,000 deposit on a pre-construction condo, and I've now turned that into a $17 million real estate portfolio. And here's my portfolio here. And I want to show, I always show my portfolio because I want to show people, hey, we're transparent. This is what I do. This is what I've invested in. On top of that, I like showing people the value of owning real estate over time. So what we're in right now is a low point, an absolute low point in real estate. We're going to get into a number of factors of why that is. Obviously, some of them are pretty obvious, but I'm really digging down into it and just showing how math and trends and everything predict to an upward trend in pricing from this point onwards. So my current real estate portfolio, and that excludes my office building and my personal residence, is valued at over $17 million. But what's cool is that there's mortgages in all these properties. So when I get into detail about a lot of the stuff today, I'm living personally the high interest rate environment. And I know what the experiences are today for a real estate investor, which will go into why we have record levels of inventory. But in 30 years, I won't have any mortgages on these properties because these mortgages will be paid off. They're paid off by tenants that live in the properties. And that becomes my retirement savings fund. So it goes from a portfolio that's worth over $17 million today, that all have mortgages on it. So if I sold everything, I wouldn't have $17 million, to a portfolio at a conservative annual growth rate of 3%. That will be fully paid off because tenants paid off and be worth $42 million. And then I want to introduce you to Niche. And then we always start off with this because we want to, again, show you the value of holding real estate over time. And it's very specific right now, showing our portfolios, showing why there's panic in the market and how you can turn panic into opportunity. So Niche, why don't you introduce yourself? And then after we do that, then I'm going to show people where the math and trends are lying.
Yeah, thanks, Alex. So welcome, everyone. Thanks so much for joining us today. My name is Niesh Dissanayake, and I've been a real estate investor since 2006. I've been in the real estate space as a realtor since 2020, late 2020. My first few investments were in the Toronto market. Over the last few years, we did look elsewhere simply because the math did not work in the Greater Toronto area. And we purchased properties out west in Calgary. But, bringing everything back to the Toronto market, I've been fortunate enough to have a successful resale business in the GTA and was recognized over the past 3 years within the 1 percentile of realtors in the Toronto Real Estate Board. And that's, now I think we're probably closer to 80,000 agents. Done pre-construction work both in Calgary and in Toronto. And in terms of my past experience, I was in the corporate space as a director of sales and operations, and truly just looking to learn. As Alex mentioned, this is a brand new presentation. So even though I'm a panelist here, I'm certainly looking to learn from what the market in Toronto has to offer, because I'm feeling like what we're about to see and learn is something that hasn't happened in Toronto for probably over a decade, Alex, maybe
Oh
even
yeah,
more.
yeah, yeah. We're looking at things I haven't seen in my career. And you're going to see this. I go back and I
There
look
you go.
at historical stats. So I've been selling real estate in Toronto since 2008. This hasn't happened in my career. But what's key is the fundamentals of the market haven't changed. And I would love to go back and find multiple videos where I've said this. I just didn't have a chance to go do it and go through all my video footage. But oh, here's Nish's portfolio right there for those that want to see it. So again, we show everything that we have. Again, we want to show you that we are real estate investors. We are invested in the market, and we practice what we preach.
And you know what? What's really good is in a couple of years, you'll have this video to show people to let them know that you were telling them to do exactly
oh
what you're
yeah,
going to tell
there's
them to do.
exactly. There are so many videos you can see, which you should go back and listen to this. But in videos in the past where I get people go, Alex, well, when are Toronto prices going to go down? And I say Toronto prices aren't going to go down. And you're like, well, Alex, right now Toronto prices are down. And I do say an asterisk, and this years and years ago I've said this. The only time Toronto real estate prices will go down is if you have a rapid escalation of interest rates. And if you have a rapid escalation of interest rates, that's because you had high inflation at that time. Said this well before COVID. You can go back and look at my videos. I said that is when real estate prices go down, a rapid increase of interest rates. And what have we just went through? We've just been through a rapid increase of interest rates. So real estate as a product of supply and demand, just like any market. You have high supply and low demand. Well, that's going to impact pricing. So let's talk about the supply side. So June, oops, that's a mistake. That's shit. There we go. Mistake number one for everyone. That should say June 2024. So in June 2024, active listings downtown were 2,000, 7,027, and sales downtown were 354. To put that in perspective, again, that should be June 2024. To put that in perspective, let's look back at the last 5 years and then go to historically look at 2009, 2010, and 2017. So when we look back and we look at 2023, well, we're up 82%. Let's see, our listings are up 82% compared to June 2023, 83% compared to 2022, 134% compared to 2021, 91% in 2020, 208% pre-COVID, June 2019. That's a pre-COVID year. These are all COVID and post-COVID. Pre-COVID year, our listings are up 208%. So let's go back. And I said when I was doing this math, and I present this to my clients as well, I'm like, well, let's go look at other periods where the market was in flux because COVID caused fluctuations in the market. So June 2017, why I picked 2017, in April 2017, you had something called the Fair Housing Act that came into play. And that's when the Liberal government at that time put rent controls back on investment properties. Well, we had 1,033 listings on the market. Then we're up 163% from that. June 2010, going back to our financial crisis year. So going all the way back then. Again, I started in 08. So listings, were 15,024, not 15,000, 1,524. So we're up 79% from financial crisis, post-financial crisis times. June 2009, financial crisis was September 08, October 08. We're looking at 812. We're up 236% during that financial crisis period where things had just grinded down. If we look at our sales way down 43% to last year, 32% to 2022, 116% to 2021, 32% in 2020, 53% 2019, 82% June 2017 after the Fair Housing Act when they said investors, you can't raise rents anymore. No more raising rents on properties built after 1992. June 2010, down 59%. Sales are down compared to financial crisis, post-financial crisis. June 2009, down 74%. So we are looking at a supply side of significantly more supply and also significantly less sales. So why are we looking at record levels of inventory? Well, investors are listing their investment condos for sale due to negative cash flow. On top of that, you have a record level of new condo completions in downtown. For example, in the entertainment district of Toronto, there are 4,000 new condos being completed this year. The previous record for this neighborhood was 1,500 in 2018. This is also leading to lower rents. Rents are downtown are lower than they were in 2019, which is contributing to the negative cash flow of these investment units. So investors are getting less rent and their expenses are significantly higher. So let's give you an example. So here's a condo, and I use this condo building specifically, 27 Bathurst. I own a unit in this building. I own a unit very similar to this unit in the building. So at this purchase price of $535,000 at an interest rate of 6.5%, and why that is relevant. Sorry, I just had some talking in the background. So when you're looking at interest rates, 6.5%, the value is $535,000 if you were to purchase that. And that's relevant because a lot of people have bought in this building, bought for a low purchase price, and may refinance these properties, take equity out. Current market rent on that is $2,550 per month when I factor in annual property tax, monthly maintenance fees. Again, I own this building, know the numbers like the back of my hand. My monthly mortgage payments on those are $2,700 at that 6.5% with 80% down on this property. So if I factor in my rent, my monthly costs of over $3,000 per month, my cash flow in this unit is negative $671 per month. Landlords up to this point were used to getting positive cash flow. This is the rate environment that they're entering in, if they're already in, if they're variable rate, or if they are their term is coming due on their mortgage and they're getting a new mortgage, and they're freaking out. They're like, oh my God, I'm paying nearly $700 per month to own this property. I'm paying someone to live in this property. This is terrible. Sell this property. Sell this property. I am bleeding. And why is demand down? Well, interest rates are impacting buyers in regards to half of them are sitting on the sidelines because they want to wait till rates come down. On the other side, they just literally can't get a mortgage because the stress test doesn't allow them to be approved for a mortgage. So that is holding them down. They just can't get the mortgage for the pricing. So I'm down significantly on the demand side because first-time buyers on the sidelines for these two reasons: to get a better rate, and they just can't get approved for mortgages, and because of the high interest rates, investors are selling their properties because they're living in the now. Remember, I said you got to look at real estate values over 30 years, but they're living in the now, and they're like, I don't want to lose $600-700 per month on this property. I don't want to lose money. Sell it, sell it, sell it, sell it. They don't want to lose money. They're not looking towards the future. So what do you want to do? You want to make money when other people panic. And that's how I turned panic into a $20 million real estate portfolio. Those landlords are panicking right now because they're losing $600-700 per month on their portfolio. But here's the thing. There's a classic line: date the rate, marry the house. That's where people are like, if you love the house, just buy the house. You're only going to be in that mortgage rate for a short period of time. My version is date the rate, marry the opportunity. And the opportunity is when you look actually at the payment, because when people buy property, they're buying the payment. They're not buying the interest rate. They're looking at the payment they have to pay monthly. That's impacting investors right now. Their payments have gone up significantly, and they're losing money, and they want to get out of the asset. That's where the opportunity is for everyone right now. So what is the opportunity? We know variable rate mortgages will be 4% by the end of 2025, which is 18 months from now. You may be like, Alex, how do you know this? Well, I listen to experts. My background's in finance and economics, but I also look at experts. I read experts. Um, I follow Benjamin Tal, who's the chief economist for CIBC Bank, and they're looking at. He's predicting that the now I got to factor in these two different things. Where I what all investors care about is what their mortgage rate is. Benjamin Tal, in what I'm showing here, is talking about the bank rate. So and the bank rate is what impacts variable mortgage rates. So the bank rate is lower than what your variable mortgage rate will be. But in Canada, he's predicting 100 basis points cuts for this year. Well, we've had 25% already, and we'll have another 25% I'm expecting at the end of this month. And he's predicting another 25%, or another 50% by the end of 2024 for a total of 100 basis points cuts. So that'll drop your bank rate down by 1%. So he is predicting that we're going to go down 100 this year, and we're going to go down to 125 next year. So that's total 2.25% reduction in the Bank of Canada rate. And what does that bring you? Well, that brings you to 2.75 or 3% by the end of 2025. That's what he's predicting. And that falls in line with a 4% variable interest rate by the end of 2025. That is a massive, massive difference from where we're sitting right now, of people sitting on variable interest rates between 6 to 6.5% right now. That's what people are sitting on. That will go down to 4% by the end of 2025. So what happens when rates go to 4%? Well, supply will go down when rates hit 4%. Why will that? Condos that had a negative cash flow are back to neutral positive cash flow, and investors will take these units off the market. The only reason investors are selling their units is because they're bleeding money. If you stop the bleeding, they're not going to give their units away anymore. That's what it is. The investors that are giving their units away are living in the now and not looking towards the future. But in the future, is if the bleeding stops, they're gonna take their units off the market. Interest rates only went up in a rapid fashion because inflation was high. Now that inflation is going down and our economy is sputtering, you're going to see interest rates go down. And then you're going to see things level off, and we're going to be back to that 4% range for, again, variable rate mortgages. Could maybe dip below that in the future, and that's going to bring our pricing back up. Also, the number of new condos downtown coming to completion will have reduced significantly. So first of all, I want to show how the bleeding stops. So let's go back to that $535,000 condo that sold a few months ago. Well, we saw that people were losing nearly $700 per month at today's market rents at 6.5% variable interest rate. Well, if I drop that down to 4%, well, guess what? My monthly cost goes down to nearly my rental amount, and that's not factoring any increases in rent. So my cash flow is neutral. Why am I going to give this unit away? I don't need to give this unit away. I can take it off the market. I can handle not drinking Starbucks twice a month to cover my negative cash flow. And on top of that, I'm not getting into in these slides because I wanted to keep this as simple as possible. But of that rent, part of that monthly cost, and part of that monthly mortgage payment, that's going down to pay the principal of the mortgage off. So even at that negative cash flow of negative $9.21, every month you're paying hundreds of dollars off the principal mortgage amount. So you're saving, you have a forced savings in the property by building equity up in the property by paying down the mortgage. You weren't paying down the mortgage this year at 6.5%. The only pay down on the mortgage is coming out of your pocket. You go back to that position when we hit 4% interest rates again, which will happen by the end of 2025. Alex, again, how are you so confident in that? I showed you what Benjamin Tal is saying. You look at what the economic data is forecasting. You're looking at a stalling economy. Things are slowing down in the US as well. Job numbers do not look as good. Inflation is going down faster than expected. So all the indicators are pointing in a downward trajectory in regards to economic activity, which means interest rates will go down. And the future supply. There are future supply issues which are going to be occurring in the market. So one of the things that I'll back it up. How condos are built is you need to pre-sell the building in order for the builder to get construction financing. Well, guess what hasn't happened in the last 18 months, looking 2023 into 2024? Because high interest rates, no one's investing in the pre-construction market. Pre-construction sales aren't happening. And from sales to completion, the process to build a building is 5, 6, 7 years. Let's just say 5 years for easy math. So you're not going to have new supply coming online in the future. That chokes off significantly. And the replacement cost of building downtown is $1,500 per square foot. So what do I mean by replacement cost? For a builder to build a building in downtown Toronto, it costs them $1,500 per square foot when they factor in land costs, material cost, labor cost, government taxes, selling costs. 15 and that's not even including profit. $1,500 per square foot, not even factoring in the profit component of that. All the costs. That's what it costs. That is what it costs to build a building downtown. It may seem crazy, but that's the expenses that we're dealing with today. So when you buy resale, you're buying below replacement costs. For them to replace that resale building, it's going to be significantly more expensive. So you have built in equity in that property looking towards the future because it costs them so much more to build that property. So any new product that comes online will be significantly more expensive. And now if you're buying into the resale market today, you're buying at a significant discount because you're buying it based on 6.5% interest rates and payments at 6.5%. But we know that by the end of 2025, interest rates will be 4%. Now you may be like, Alex, but like how can that be possible? How can building costs not go down because there's less activity? Shouldn't those costs go down? Well, this is from Altus. So Altus does all the costing for builders. That's what they do. Altus is a consulting company that does the costing for builders. And this is the report that these are excerpts from the report that they sent out to their clients, their builder clients, going what they expect for costs. Labor costs are going to increase, aren't going to decrease. Union agreements, in addition to increased cost of living, mean there is little wiggle room. So you see striking action out there. There are strikes. So labor costs are increasing. And I don't even have this included in here. But on top of that, labor costs are not going down, even though there's less construction activity on the residential side. And we'll get into more of that in a second. But also, you're losing workers. So your supply of labor is decreasing because guess what? They're all retiring. So your construction workers, your experience is all leaving the industry. You have significant retirement. There's a significant population of the construction workforce that is retiring, that is leaving the industry, which impacts your labor supply, which then impacts your labor costs. Material costs, they've stabilized, but no big reductions. So your material costs are still quite high. And if you've done any construction work on your property lately, you're going to go like, wow, this stuff's really expensive still. It's not going up anymore, but the prices are sticking. They're not going down. Ultimately, midterm, you're going to run into supply issues come 2026, supply issues of labor. Labor demand is going to be greater than the supply of labor in Ontario, British Columbia, and Nova Scotia. Hey, guess what? Toronto's in Ontario. And there's going to be labor competition. So yes, residential activity is down, but there are massive infrastructure projects on the horizon. The people that work in the residential construction, they will just go to commercial construction, and then you'll lose them to these massive infrastructure projects, institutional projects, transit. So when you look at in regards to the Ontario line that's going through Toronto, the construction labor there will pull away from the construction labor available for the residential construction. The new highway they're looking, Highway 413, that is going to, is it 413? Whatever it is. But the new highway they're looking to build north of Toronto, that's going to pull away from your residential construction pool. At the same time, when you have that construction pool, those individuals decreasing, that pool is decreasing because those individuals are retiring from the industry. Oops. Conclusion, and this is their conclusion, not me. This is literally taken from their report. Long story short, if we don't make major changes to the market, it's going to become expensive to build anything, anywhere. That's what we are. And if you look at demographics and everything, that is what we're pointing to, because I look at things medium to long term. I don't look at short term. I experience the short term, but I look at where is my opportunity in people that live in short term. People that only analyze things in the short term, that's where I look at for my opportunity. Because when I look at things medium, long term, I know interest rates are going down. That's a given. But I also know that my replacement cost is significantly higher than my current existing inventory. I also know labor costs are going to go up due to competition, due to infrastructure projects, and a decreasing pool of labor. And we're going to go on the demand side shortly in regards to the significant buildup of buyers that is growing right now. That is all sitting on the sidelines. Now, on top of that, let's talk about that supply side. So I said that it takes 5 years to build a building. We're dealing with record low sales. 2024 is expected to see the fewest GTA new condo sales in 2 decades. But you're like, wait a second, Alex. Don't we need record levels of inventory for housing? Aren't we in a housing shortage? But they're going to be building. They're not going to be building. Aren't they supposed to be building more houses, not less houses? This is the irony of the market right now. We have low sales due to high interest rates, but you need those sales in order to build the inventory. And that isn't happening. And that's going to have significant impacts. Bullpen again is a industry resource that does consulting for the high-rise industry. Bullpen predicts that 2024 marked the lowest year for new condo sales in GTA over the past 2 decades, only predicting 10,000 new condo sales. This downturn is anticipated to be more prolonged than those observed in 2009 and 2013. Not expected to recover until 2026. So now we're looking at mid-2023 to end of 2025. So let's say that's 2.5 years of record low sales of new construction projects, which will then impact the pipeline of new product being built over the next 5 years. So that's going to impact your completions come 2028, 2029, 2030. There's going to be huge issues when we look at that period over the next 7 years, from 2023, so going into 2023 when sales basically stop, all the way to 2030. And this is what the supply looks like coming online. So again, I talked about, okay, well, we were dealing with a significant amount of new condos coming in online downtown Toronto. A lot of that supply is coming online now 2024. This future supply that's coming online, so this is scheduled completion. So this is condos that will be completing in the future. When we look at downtown Toronto, there's not that much completing after 2024. A lot of this, the majority of the supply that you see, this bump of supply, so we do see a lot of supply coming in 2025, slowing down in 2026, and then dropping off a cliff below average in 2027, and then only 5,000 come 2028. And again, this bump here, this increase in supply, that's more 905 GTA areas. not your downtown Toronto areas, because that bulk came in this year right here in 2024. So you're going to have a big bulk of supply coming in 905 and then drops off a cliff. And you can't ramp it up because those pre-construction sales aren't going to come back till 2026. So that means if pre-construction sales aren't coming back to 2026, you're not getting new supply until 2031. So this is going to just be there's going to be no completions in this period in time. So you got to look in the medium and long term to see where the opportunity is. Demand will go up when rates hits 4%. Why will demand go up when rates hit 4%? First-time buyers that could not qualify for mortgages are now able to qualify. They can qualify for the mortgages. Buyers waiting for rates to come down will also enter the market. There are people that can qualify, but they don't want to pay the high rates. So they're going to come back to the markets as well. When I have someone reach out to me going, Alex, should I buy right now? I'm like, well, you can buy now or you can buy later and pay $100,000 more. What would you rather do? You could, in that period of 12 months to 18 months, you may pay $600 more a month on your mortgage. So let's say it's $600 a month in the mortgage. Heck, let's say it's $1,000. Let's just say it's $1,000 more. You're going to pay $1,000 more for your mortgage rate right now than let's say in 2025. So if we do easy math in a 12-month period, that's $12,000. But if that property costs you $100,000 more, aren't you better off paying $12,000 more for a 12-month period versus paying $100,000 more in regards to what the purchase price is in the future? That's when you look at leveraging and equity. This is going to happen. On top of this, there's demand that people don't talk about. And it's the new Canadians. New Canadians will start buying their first properties. We have had record levels of immigration. Now they're going to start participating in the housing market. New Canadians rent for the first 1 to 3 years before they make their first purchase. They have to establish themselves and everything like that, but they are eager to get into the market. They don't want to be paying rent. When you pay rent to me, you're making me wealthy. They don't want to do that. They want to get wealthy themselves. That's why they took the risk of leaving their home country and coming to Canada to set themselves up. And they know that home ownership, which they may not even been able to do back where they were originally, they can do, and they can easily enter here, and it's fully controlled and regulated, and you go get a mortgage. These are easy things for them to do. They're going to build up their down payments. They may share that with other family members, and they're going to buy their first property. That starts to happen in 2025. On top of that, there's a gap of affordability between houses and condos. Condos will be the only affordable option. The same thing happened in 2026 to 2027. 2016 to 2017, you had a big jump in condo prices because you saw the gap of affordability in the freehold market to the condo market grow significantly. Same thing's happening right now. You're seeing the freehold market, so houses, the roofs over people's head, those pricings have recovered. Those prices are still high, and specifically when we look in Toronto, the supply of houses isn't even fixed; it's decreasing. There's only so many detached and semi-detached and row townhouses in Toronto. There's no more land to build those. You're building more dense products, so that pricing has gone up significantly. Well, and condo prices have come down here from 2022. My gap has grown. That first-time home buyer, they're not going to be able to jump right into the housing market. They're going to go into the condo market. It's literally the only thing they can afford. You own a condo for 5 years, you cash that in 5 years and use that to buy your first house. That's the formula. That's what I did. That's what people are going to do. So when interest rates go 4% and all these first-time buyers can come into the market, they still won't be able to afford a freehold house. They're going to be buying condos. And you also have all the new Canadians coming in. And let's look at that. I wanted to show you the graph. So we're chugging along, immigration, normal, boom. 2021 to 2022, 2022 to 2023. Again, 1 to 3 years, they establish themselves and they will start buying their first properties in Canada. All those individuals have not started participating in the real estate market yet. They are coming, and they're coming when interest rates hit 4% in 2025. This is just math. This is just trends. This is just demographics. If you just look at these things, you can predict the future. So how do we identify the opportunities? I'm not saying that every condo you go buy today is going to go up $100,000. You have to look for the opportunities. This is how I identify the opportunities on the market. You look for properties that are down from peak values. Look for properties that will cash flow at the 4% interest rate. Because remember, those properties are going to be taken off the market when landlords go into a cash flow positive or cash flow neutral situation again. And run our payment formula to identify future value. So I'm going to go back to the example I was showcasing previously. I gave you the example of 27 Bathurst, condo building. I know Minto Westside, know it very well, own in there. Sold 40 to 50 units to investors in that building a number of years ago when it was in pre-construction. So that same layout, again, same layout I have, these two are the same layouts, clear west-facing view. In 2022, that same unit that sold for $535 this year sold for $700,000 in 2022. That's a discount in price. So even when you see the reports where in the newspapers, well, condo prices are still holding their own, you can identify pockets in the market right now where you're seeing significant price drops from the peak market. So that's a difference of $165,000. It's a 24% drop in price values. That's number one, criteria one. We've seen a significant drop in regards to values. Okay, so meets criteria one. Criteria two, look for unit of cash flow, the 4% interest rate. We already went through that once before, but again, if we bring rates down to 4%, then I'm cash flowing at that $535,000 purchase price. So yes, if you were to buy this condo today, you're going to be negative $671 per month. But if you look at that cost over an 18-month period, you know, $10,000, $11,000, $12,000 going to cost you. But I'm going to show you where the opportunity is. So, and again, your interest rates are going to be going down during that period as well. So it's not even going to cost you that much. Maybe it costs you $6,000, maybe it costs you $8,000 in regards to negative cash flow over that period, which again is a write-off to your income as well. So that's going to, your after tax amount is less than that amount because you can write that off against your income. So your actual cost maybe cost you $5,000 after tax. Then we analyze the opportunity. So we run our payment formula, identify future value. Remember I said, date the rate, marry the opportunity of the payment. So I read two examples here for people. And this is very important. So we know today that at $535,000, someone is willing to pay that. And that means at a 6.5% interest rate with 20% down, they're willing to make payments of $2,705 per month. That's my monthly mortgage payment. On top of the market rent of that on that unit is $2,550 per month. So let's look at the value. We're going to do algebra here, simple algebra. Let's look at the value. So if my interest rates are 4%, so I have a 4% interest rate, but the payment on that, and if I match up the payment of $2,705, okay, so 4% interest rate and a payment of $2,705 per month, algebra, then what's my value? Well, that value would be the equivalent of buying something for $708,000, $708,500. So that's if I'm looking at the value at 4%, equated to the payments of 6.5%, which is very similar to that pricing that we saw in 2022 when this unit hit $700,000. The difference, $173,000. Okay. Let's play the conservative side. What if we just look at it matching what the market rent is on the property? Because that's when you get in the equation when people are looking at these properties, like, well, why rent when I can own? So why give a landlord $2,550 per month? What if my mortgage payment equaled that? Well, at 4% and a mortgage payment of $2,550 per month, that equates to a value of $667,000 per month, rounding up to $668,000 per month, the difference of $132,750. So between that line, if you were to buy, if you were to have bought that condo in March for $535,000, by the end of 2025, that condo will be worth anywhere between 667,000 to $708,000. A spread, an increase of anywhere between 132,000 to $173,000. It's just math. That is what's going to happen. That is what people have been doing for years and years. They don't look at interest rates. They look at the payment. They care about the payment. Date the rate, marry the opportunity. So we have to look at what the value will be at future interest rates. Again, at the beginning of the presentation, I said Toronto real estate prices only go down when you have a rapid increase in interest rates. All the same things still apply and why real estate values were going up over the past decade. None of that has changed. Now, when interest rates go up, values are going down. And guess what happens when interest rates go down? Prices will start going back up again. And that's where you make money when other people panic. But why should you listen to me? You go, Alex, you said you're a real estate agent. Why should we listen to you? Well, here's some things I've done when people said I shouldn't. And I've made a significant amount of money doing this. So I started buying apartment buildings in Hamilton in 2024 when everyone said no one will live in Hamilton. What I saw was that people couldn't afford to live in Toronto. So where are they going to live? Well, they're going to move to Hamilton because what Hamilton had to offer was a real city. It was just waiting for it to that demographic shift to move to Hamilton. The artists couldn't afford to live in Toronto anymore. When artists can't afford to live somewhere, they're going to move somewhere more affordable. They move to Hamilton. What follows artists? People start with money, start following artists. You have gentrification of the neighborhoods, values go up. So I bought my first building in Hamilton, an apartment building, 12 units for $995,000. I had to invest $500,000. It was a rundown building, so we invested $500,000 into that. So the actual number, let's say I had fully invested in there, was closer to 1.5 million, but it's now worth 4 million in 2024. I told people to buy Oakville, north of Dundas, in 2019, when everyone said people won't live in a field or a condo in Oakville. That's what people told me. But I looked at them like, well, it's $600 per square foot here, when the equivalent product in Mississauga next door was $1,000 per square foot. But the spread between freehold and condo were much greater in Oakville than it was in Mississauga. Hey, and guess what? Was right on that one too. I told people to invest in Calgary in 2019 when people said Calgary only goes down in value. In 2024, it is the only market in Canada that has seen double-digit price growth. I made a $200K profit on the first house I bought in Calgary. I make money when other people panic. I turn a panic into a $20 million real estate portfolio, and I follow the math, identify trends, and go where others are running from. People are running from downtown Toronto condos. That's where we need to look, because if we look at the fundamentals haven't changed. The only thing that changed was interest rates. And then you had an increase in supply and new condos that are completing, but that is ending after this year. The math, the trends, everything tells us we should be looking at downtown Toronto condos. So now I will open the floor to questions. Team here, Niesh, Kyle, Alex, thank you for listening. I encourage your questions. I'm excited to answer your questions. So I'll open the floor to questions. The Q&A box is down below if you do have any questions.
As questions come in, Alex, yeah, thank you for doing this. It's very, very informative. I love seeing the math, the two different examples that you showed. It's definitely getting the gears going a little bit.
So yeah, so first question just came in. What about Durham area of condos? I'm focused on downtown. Where we look at that supply increase of condos, in that future supply where I showed you that graph, you still have a lot of that supply to work through in the 905 areas, including Durham. Um, and I don't have the same spread in regards to values, in regards to condos and houses in the Durham area. I'm looking the same. I can buy a one bedroom in Durham for the same price of a one bedroom condo in downtown Toronto. I agree that time is now. What if you don't have funds for down payment? What are other options? Uh, I would say I'm going to have a presentation on that next month. So that's my presentation in regards to don't lease, buy, which will include where to get the down payment funds, and that's where you got to build a business case. Essentially, what it is, you got to build a business case, and then you got to go to people with money. You go to people with money and you show them the opportunity and go partner with me. And I don't have the funds, but if you help me buy a property, I'll live in the property. And when the market recovers, I'll pay you back your down payment plus some profit. So you got to build a business case around why people should give you money to buy a property. Is it advisable now to buy in Edmonton? We're not big Edmonton people. If you were looking to invest in Alberta, Calgary's where it is. Edmonton will not see the same price growth as Calgary will because you just don't have the same high-end job base in Calgary that you do. Sorry, you don't have the same high-end job base in Edmonton that you do in Calgary. But if you send us an email, Niesh can get back to you. We actually have a whole video on why buy Calgary over Edmonton. So we can send you those full details there. Very smart. So you'd say the time to buy downtown is right now, or should I wait a bit more? Now. Like, start identifying it now. Start doing it now. You can never perfectly time the bottom of the market. So the street, so Bay Street, 91% chance of a rate cut July 24th. Okay. You have your next meeting will then be in end of September, and then you have another meeting in September, October. Then you have another meeting in December. So you could have rate cuts then. I don't know when things will start jump starting, but if I show you that exact example that I showed you on the screen, I would say buy that right now. Buy that right now. It's sold. It's sold in March. Buy that right now because I don't know when things will pick up, but you should be buying that unit every day of the week. Every day of the week. Why try save $5,000 when your upside is $150,000? Just jump on the opportunity. Any specific areas downtown? It really just the three criteria: 1, 2, 3. 1, significant drop in value. 2, cash flows at 4%. 3, look at my payment value evaluator, and that just shows you the spread of the upside from rents to the payments at 6.5%. So it really depends if you saw that big drop. And that is going to identify the area if it's a good opportunity, because you saw at one point people are willing to pay this much to live in that area. So we know that people are going to be willing to pay that much in the future to live in that area. So it really just specific in regards to the opportunities in the building. So it's more building specific than area specific. Also, I like focusing on buildings that were built after November 15, 2018, because those buildings don't have rent control. So we focus in on newer buildings because if you're an investor, you want to be able to increase rents. Is it better to invest in pre-construction or to buy an older building at a prime location in Calgary? It just depends on what you want to do. We can do both. We have the ability to do both. The thing is about Calgary is that there was no building activity really from 2014, 2015 on. So you're buying an older product where people are, from a rental perspective, people want to live in newer product. So a lot of the inventory out there is 10 plus years old in resale because they just didn't build anything for 10 years because the market went down. So we do like the pre-construction opportunities in Calgary. Also, it just means you don't have to get a mortgage in this environment. And you can continue to watch prices can go up and rental rates go up. Why not invest in 2025 when inventory keeps building up with 25K scheduled occupancies in 2024 and 40 in 25? Again, that's not downtown Toronto. That's GTA. I'm focused specifically in downtown Toronto. And downtown Toronto, a lot of that inventory is completing this year, not next year. It's just all it's all into this year. Because what happened was that pricing got really expensive in downtown, and then builders moved out into other areas. So a lot of the pre-sales that happened in the 905, which then go into construction periods in which their completions are matching up. So yeah, if you want to buy in let's say the Square One area, sure, but I've never liked Square One personally. I'm just picking on an area. Downtown is where the opportunity is because again, I have similar price points in downtown right now that I do in 905 areas. That's where the opportunity is. Pierre Poilievre promises improved housing affordability. Is there a risk for investors that appreciation might be impacted? Pretty sure Justin Trudeau promises improved financial affordability. I'm pretty sure Doug Ford promises improved housing affordability. Pretty sure everyone promises improved housing affordability. Guess how things can get more affordable? Lowering interest rates. Not and the government doesn't have control over that. They're the only way to reduce construction costs is through well, I actually just showed it's $1,500 per square foot to build it, and you would have to build huge efficiencies into the industry, which isn't going to happen overnight, and you don't have enough workers to build it anyways. So improved affordability and downtown Toronto isn't supposed to be affordable. It's not. It's not. I can tell you guys a story. Um, I'm from a small town in Northern Ontario, and my father worked on the railways. He was a car mechanic. That's what he did, fixed train cars. Growing up, he got a layoff notice, and it looked like he might get laid off. My family was talking, and we might have to move to Toronto, to because he needed to get a job. So I was excited. I'm like, yay! I get to move out of my town of 4,000 people, 45 minutes north of Sudbury, and be in the big city. Well, the layoff didn't happen. They stayed in Gabriel. And years and years later, I was selling real estate, and I'm like, Mom, Toronto's really expensive. Like, where were you guys going to live? She's like, oh, we couldn't afford Toronto. We were looking at Orangeville, and we couldn't afford Orangeville. And this would have been like this is like 19. This would have been like 1998, 1999 area. If we're looking at timing, just to put that in perspective. And the CN yards are specifically in Vaughan, for those who want to get a geographical location. Couldn't afford it. Downtown Toronto's not going to be affordable. It's just not going to happen. So affordability can mean different things in different areas, but downtown Toronto isn't going to be an affordable area. It's not supposed to be. Is New York affordable? Is Miami affordable? Is London affordable? No, and it won't be. Are you better off buying an existing condo and carry the difference in mortgage versus rental income, or buy a pre-build with just a cash investment and no rental income? There are definitely opportunities in the pre-construction world right now. There are good incentives you can get in the pre-construction world right now. If you don't want to deal with negative cash flow, then yet absolutely you can look at buying a pre-construction condo right now. You will pay less for a resale condo right now. You will pay below replacement value for a resale condo right now. But if you do not want to deal with negative cash flow, if you don't want to deal with getting a mortgage, if you don't want to deal with a tenant, then you can look at the pre-construction industry, because there will be those issues coming up in the future, and there will be no closings for you to compete with in the future, because as you saw in the graph, there are just no closings coming up in 2028 and beyond. And those closings won't start picking up again until 2031, 2032, because it just takes that long to build and the whole process. So there can be opportunity there. It just depends on how you want to invest. I do see there's better opportunity right now to make a significant return in a short period of time looking at the resale market. But there are investors that just invest differently. And I built my whole portfolio Well, all those properties I showed you, other than that apartment building, I bought pre-construction. Apartment building and personal residences, I bought everything pre-construction. Hi, Alex. All your speculation is based on the assumption that interest rates will go to 4% by the end of 2025. There is another storyline that inflation could be stubborn if the interest rate cut, and the inflation will be worse than the 1980s. Again, I'm saying this. The chief economist for CIBC Bank is saying this. I haven't read an economist that has said that interest rate cuts aren't going to drop to the 4% level and inflation will be worse than the 1980s. It's not happening. You're just looking at data, you're looking at job data, and you're looking at economic activity. So that isn't happening. Do you only handle condos in Toronto? Are you in a freehold townhomes? We do everything. We sell all real estate in Toronto. What do you think about assignments versus resale condos? Again, you can get into the resale market, the assignment market, and buy an assignment and get someone that's going to give up some of their deposit. Absolutely. There's options on that. I do still see better opportunity in the resale market because there are significant closing costs that come on the assignment side. But again, it just depends on what the opportunity is. But yes, there's absolutely opportunities on the assignment side. The measures are taken to limit immigration number of foreign students. Is it not a headwind for real estate investment? No, because if you go back to my graph, actually, I want to go back to my graph. Let's go back to my graph. Let's go back to my graph. Okay, there's my graph. Now I need to share my screen. Not fast enough. Okay. Screen back. Niesh, are we back on the immigration screen? Okay. So we're talking about reducing immigration numbers. Well, if we reduce immigration numbers, we just go back to what we were doing in the past. So we're not going below what our average was for 2 decades prior. And they're not even talking about going below. They're not even talking about going back to the average. They're saying reducing these high levels. So even if you cut off 100,000, and by the way, when you're talking about this is new Canadians. This is PR status here. Students are completely different. And by the way, the number of international students that came in was an incredibly high number, and those people don't get to participate in the resale market. They can't buy. And you mean like, Alex, yes, they can. Students can buy. They can buy up to $500,000. There aren't properties in downtown Toronto for $500,000. It doesn't exist. So it has no impact on the investment market in downtown Toronto. And even with reductions in immigration, and those numbers are looking at reducing. They're reducing the number of they're reducing the number of foreign workers in Canada. They're not reducing the number of immigrants in Canada. The number of foreign workers with visas and then new Canadians, it was over 1.2 million people. That's the number that they were looking at. And again, the only people that can participate in the resale market are these new Canadians right here, because it is illegal. It is illegal to buy real estate in Canada if you're not Canadian. And yes, there's some provisions for foreign workers, and yes, there's some provisions for students, but they are also capped in regards to different values and different taxes associated with them. They have zero impact on the market, absolutely zero impact on the market. They can't even get mortgages. The bank isn't giving them mortgages. So they're a non-factor on the market. But in regards to when you look at, so we're talking about immigration, you got to look at future demographics as well. So look at what's happening in the future. Canadians aren't having babies, and you need replacement workforce. Canada needs immigration for population growth. Needs immigration for population growth. I say it twice, or I say it 3 times, because you have to look at future demographics and moving forward. You need those individuals. We don't create enough people domestically through birthing children to run this country, to have an economic impact. You need the new Canadians. So even if you reduce those numbers, there's a number that won't go down below, because you actually have people that in the back room. Front room is politicians that are saying things to get voted in. Back room are the people that are actually running the country, and you actually need these numbers to sustain the country. So you may see a reduction, but it's still going to go above the 2 decade long average. Can you send me an email what you have available? If you just send me reply to the email you got for this webinar, and we'll open up a chat and get going on that. Why buy resale versus assignments downtown? You can buy either. It just depends on where the opportunity is. What makes the most financial sense? From where I go from peak value to down value, I'm okay with buying assignments. Don't have a problem. It just depends on it. I just put it into my analyzer. 1, 2, 3. Am I down significantly in value? 2, am I cash flow positive at 4%? 3, what's my future value when I look at the rental rate, and what's my future value when I look at payments that people are willing to pay for? That's all. That's all. Simple 1, 2, 3 step to identify the opportunity, and then you can compare them side by side to assignments to resale. I'm open to both. I have no issue. What's your view on rent growth? Rent decreased by 200 to 300 this year. Compare with last year. Yeah, because the supply increased. Supply won't increase the same level next year. It's just because you had all these new condos built downtown. That's all. Where I go back to that entertainment district, I throw 4,000 units on, which is the most ever in that area. Previous high was 1,500, and then I got to absorb all those rental condos in the market. That was the issue. Once that's done, let's go back up again. Yes. So someone asking just in regards to what, well, there's the email. Just gonna grab that. Thanks, Iffy. Yeah, there are various a whole bunch of incentives and builders to sell existing product right now. But when those are gone, they're gone. They're not going to come back. So you're in a period now where you can get incentives from builders. Would you recommend buying a condo located near an upcoming subway station? Absolutely. For example, that condo at 27 Bathurst is right by the Bathurst station in King West. Absolutely. I own the building. I'm not going to sell that because I'm getting, there's a subway station that's going to be opening right there in King West in the future. Okay. Yes, this is all recorded. You'll get a copy. Do you suggest buying? Okay, so great question. I actually like this question. So do you suggest buying with more than 20% down payment? Is it a good idea to reduce versus the cash flow for an investment property? It's up to you guys. Up to you how you want to invest. Okay, I'm going to tell you guys a story. Again, a number of years ago, I'm down in for a real estate conference, and it was real estate agents from across Canada and the US. And I gravitated towards an agent from New York City, and I gravitated towards an agent from Miami. Why that is because those two cities in America have similar product styles as Toronto in regard to they have condo buildings. A lot of the US doesn't have condo buildings like we have in Toronto. And I said to them, I'm like, hey guys, like, 20% down, we're positive cash flow in Toronto. What's it like in New York and Miami? Similar, 20% down. They're like, 20% down. You put 50% down in New York or in Miami, you're still not positive cash flow. The answer is that markets evolve. The only reason we use 20% down is because 20% down is the minimum amount of capital we have to put down on a property that a bank allows us to get a mortgage. If the bank said 30% down, we would use 30% down. The bank said 10% down, we would use 10% down. There's no reason why we have to use 20% down. It's just people's choice. So the answer is, if you want to reduce negative cash flow, then you can put 20% down. You can put more than 20% down on a property. Nothing wrong with that. But 35% down, 65% loan to value on it if you want. Up to you on how you want to look at it. There are people that just don't want to be negative cash flow, so they put more capital down. Now that's going to affect your rate of return. because your rate of return is based on how much money you put down on the property. But it just depends. There are people that own properties all cash. Um, that gives you a terrible rate of return. But they just want to own the property cash and have a property downtown that's going to go up in value. So it just depends. What type of condo would you recommend? High rise, mid rise, condo, townhouse, 1+1 or 2 bedrooms, 1 bedroom with parking, without? Depends on the opportunity. Always depends on the opportunity. I've always said this because I own studios to 3 bedrooms. I own them all. It just depends on the opportunity. I own high rises. I own in low rises. I own a townhouse. All just depends on the opportunity. Just goes to the analyzer. 1, 2, 3 meets the 1, 2, 3 criteria. That's goodbye. Yes, negative cash flow can be deducted against personal income. For a brand new investor, is your company able to guide them through buying process? Absolutely. Our line is maximize your wealth and minimize your stress. That's what we do at Wealth Builders. North York. So I will answer North York. North York, 1 bedroom condos sell for more than downtown Toronto condos. Because I have one in North York right now, at Yonge and Finch, 15 homes. And I look at the values. My values there are higher than my 1 bedroom condos in downtown Toronto. My rents are higher in North York than they are in downtown Toronto. Blew my mind. So yeah, I do actually like North York and North York. North York, I don't have a lot of inventory in that Yonge line between Shepherd and Finch. And there is specific demand for that area. So I do like North York, but again, has to fall into my criteria. From your experience of investing in condos, is a 2 bedroom or 1 bed better for ROI and renting? I have found 1 bedrooms are have performed better for me. Yeah. I'll just wait 1 more minute in case we have any more questions. Otherwise, we'll wrap this up. I'll wrap this up at 1:15. I do thank everyone for staying in online. Obviously, we had a lot of questions come online. So I appreciate it. 26 questions altogether on the Q&A portion. But I do truly think, I don't want to say it's a once in a lifetime opportunity, but the math points me towards the opportunity right now in downtown Toronto condos. And it's just that simple formula that I showed, that 1, 2, 3 step to identify the opportunity. Iffy, thanks a lot. Glad you enjoyed. So I'll wrap this up now. Again, this was recorded. You guys are all get a copy of the presentation. It'll probably solve the mistake of 2023 versus 2024 in there, but I'll make that correction for future presentations on this. If you're interested, reach out. You'll get this email tomorrow with the recording and opportunity if you want to book a call with us. But I think easy $100,000 you'll make an upside in a property in 18 months. And I just presented everything there. Do some of your own research as well. But the negative media out there, and this is why it's great right now. Everyone's saying condos are bad, condos are evil. Guys, I've been hearing this for 15 years. Condos are bad or condos are evil. And that's when people are doing podcasts and webisodes and like saying bad things about condos. But the reality is, if that's the only thing that people can afford, then that's what they're going to buy. And I showed you why there's going to be supply issues. I showed you why there's huge supply right now, and I showed you why supply will go down in the future. And I showed you that replacement cost is $1,500 per square foot. All these point to upside in the future. Very confident in that. Again, thank you, everyone. Niesh, you want to say anything quickly at the end?
No, again, very informative. I was a fly on the wall for this one. So thanks for having me on and allowing me to show my face.
Yeah, Niesh didn't have an opportunity to look at this before. This is not a lack of preparedness. He's a very prepared individual. But I generally finish these presentations half an hour before I present them. So he didn't have an opportunity to look at it before. But
No,
otherwise,
that's okay. That's okay because you did the exact same thing with Calgary, and look
yeah,
at the amount of money that I made in Calgary
yeah,
by
exactly.
watching it. So
For me, it's a no-brainer. Again, we're happy to go in depth. If the condo fees don't bother me at all, I'll go into detail and we can go into detail on those at all. The condo fees don't scare me at all. But again, thank you, everyone. We'll talk soon. See you guys.